Imagine experiencing a similar bear market as the longest bear market in history, the stock market crash of 1929. It lasted almost 3 years and the S&P 500 lost 83.4% of its value. Imagine, who says it can't happen again? And who says it can't go any worse? Whatever the case, Jeremy shows us lots of signs of bubble territory. And one of the bubble signs Jeremy points towards is the extremely high PE ratio of the S&P 500. Take a look at this chart, for example. It's clear that the last two market crashes, in 2000 with the dot-com bubble and 2008 with the housing bubble, had a really high PE ratio. Now in 2021 you can see another clear spike in the PE ratio, meaning, according to this graph, stocks are in extreme bubble territory. Jeremy guesses that the longest this bubble may survive is the late spring or early summer. In other words, we're almost near the end. Or if you see it the other way around, we're almost near the beginning of a big crash. Another sign we are near the end of a bubble, according to Jeremy, is the acceleration of the final leg. Looking at the S&P 500 return, you'll see that the 10-year return is close to 15%. The return of the last 12 months is close to 70%. Then I also read an article from Robert Shiller from March 5 in the New York Times. Robert won a Nobel Prize in 2013 for their unique way of analyzing asset prices. Robert came up with another way of analyzing stock prices. It's called the CAPE ratio. And I'm not sure if I pronounced that correctly. But anyway, a high CAPE ratio suggests overpriced markets with low returns as a result. Especially the US market has a really high CAPE ratio. And the CAPE ratio is somewhat around 35 today, which is lower than its highest level of 45.8 in March 2000 at the dot-com market crash peak. Still, it's relatively high today. Robert rightly points out that stocks might be high, but he asks the question, is there a better and safer place to earn money if you sell your stocks? He explains, because of the fact interest rates are still low, stocks are still more attractive than the bond market. According to Robert, if you are overexposed to stocks, which is me since I only have US stocks and some crypto, selling some stocks to buy bonds might be a good choice, according to him. As of this moment, many investors experience the TINA mindset. And TINA means there is no alternative. What other alternative is there to earn money if I were to sell my stocks? And lastly, I read the latest memo of Howard Marks and would like to share some of his notes. Howard is an American investor and author. I read his latest book a few years ago. It's called Mastering the Market Cycle. It's definitely a reading tip. Anyhow, in his memo he writes that one of the biggest risks of falling stock prices is the rise of interest rates. He explains that the interest rates have declined steadily for the last 40 years, which is one of the big reasons we see that high stock prices right now. Since interest rates are already historically low and hardly can go even lower, the rates can only go sideways or up. Howard shows that today's 1.40% yield on a 10-year treasury is up from 0.52% at the low of August 2020 and from 0.93% in just the last few weeks. Howard's memo dated March 16. On April 6, the yield on a 10-year treasury bond went even higher to 1.73%. In the end, Howard concludes that there are more and more mentions of a possible bubble based upon the high valuations, government spending, inflation and interest rates. Still, he also sees lots of positive things and therefore doesn't have a bearish outlook on the market. So I just shared the thoughts of 3 very smart people that have lots of experience in the stock market. Jeremy thinks we're in a bubble and that the bubble will burst in the spring or in the beginning of the summer. Robert agrees that stocks have a really high price compared to the past, but basically says there is no alternative to stocks. He doesn't know what will happen in the near future. Then lastly, there's Howard. Howard also agrees that stocks prices are very high, but he argued that these stock prices aren't that crazy if you look at the entire economy, such as the extremely low interest rates. Furthermore, how it doesn't have a bearish outlook on the near future. In other words, no one knows what will happen. So for test purposes, I created a spreadsheet to determine what would happen if one were to buy a piece of the market every single month for a fixed amount, starting in November 1927. So like 90 years ago. So that's before the big market crash of 1929. So try to see yourself in that situation. You started 1 or 2 years ago buying the S&P 500, same as me, and then suddenly there is a big crash. What happens to our portfolio, and more importantly, what happens to your strategy? Do you keep buying, or what do you do? So again, the starting month of November 27 is like 2 years before the market peaked in 1929. You would start to make a loss at around 3 years into your investing journey. From June 1930, the market really started to crash. Your worst month would be 2 years later. If you were to invest $1,000 every month from the start, you lost $41,000 of the total $56,000. That will be a really sucky feeling, to be honest. We can imagine this right now since we are so spoiled with new record highs almost every week. From the moment I started investing in May 2019, I only saw one major correction last year, February 2020, when the pandemic hit. But then again, it didn't take long before the crash ended a few weeks later, on April 7. So coming back to our imaginary investment 9 years ago, it took another 3 years before I would see my investment turn green again. I would have needed an iron mindset to keep buying every single month for over 5 years without seeing any profits. Then another 2 years later, in 1937 and 1938, the stock market dipped again, turning my profits into losses once again. This means after 11 years of dollar cost averaging, starting November 1927 to May 1938, I saw a loss of almost $20,000 from my total investment of $127,000 of buying $1,000 every month. A few years later, then there was another dip during World War II in 1942. After that, the market went up for the next 25 years or so. Just so you know, I didn't calculate dividend yields into my example, and therefore the actual scenario will be better than the one I just showed, but still it probably will be a hard time to keep your chin up during those tough times. So all in all, in the end, in my opinion, you can't go wrong by dollar cost averaging the S&P 500 if you have a long time horizon, like 15 to 20 years or more. The thing is, especially in those long down cycles, I believe it will get hard to keep putting your money in when you see it falls more and more for years. Luckily, I haven't experienced such difficult times yet, but hopefully I will stay disciplined and focused if such bad times come. So what do you think? Do you believe you will continue pouring your hard-earned money into the stock market when there is a downward cycle of multiple years? Let me know in the comments. So thanks for watching, and hopefully I'll see you next time. Bye bye.